Stop what you're doing for a second, because gold just made a move that most people are going to explain the wrong way. And if you own even a single ounce of gold, even a small silver position, or any mining stocks at all, you need to understand what actually happened before you make your next decision. On Friday, gold jumped hard, roughly a couple percent, depending on whether you're looking at futures or spot, and silver moved with it. The safe assets came back fast after getting hit earlier in the week, and the headlines are already recycling the same familiar explanations: geopolitical fear, safe haven flows, flight to quality. You've heard those lines 1,000 times. But here's the problem. Those explanations only cover part of the story. And when you trade or invest with only part of the story, you don't just risk missing upside, you risk getting shaken out entirely right before the biggest move. So what I'm going to do here is walk you through what's happening under the surface. Why gold and silver moved the way they did. What central banks are signaling in a way most mainstream coverage won't connect. Why Treasury yields can be a short-term obstacle but a long-term boost. Why the biggest institutional money still hasn't truly entered the gold space. What the Iran conflict means specifically for silver. And why Bitcoin, yes, Bitcoin, may be delaying the kind of gold rally that would normally already be obvious. By the end, you'll understand the mechanics driving this market better than most investors who talk about it every day. And more importantly, you'll have one framework that separates the people who profit in precious metals from the people who get forced out at exactly the wrong moment. One quick thing before we dive in. If you want analysis that focuses on mechanisms instead of hype, make sure you're following along here so you don't miss the next breakdown. Because in markets like this, timing matters. And by the time the popular narrative catches up, the move is usually already underway. Now let's get into the substance. Gold finished Friday with a sharp gain, spot outpacing futures, and silver followed in the same direction. The numbers matter less than the message. This was not a slow grind. This was a snapback move with urgency behind it. Most people will say, Iran, safe haven, end of story. That's not the end of the story. That's the first layer. Layer one is the obvious explanation, and it's real. Geopolitical risk is elevated. The US-Iran situation is tense, unpredictable, and it is creating genuine uncertainty. When uncertainty rises, money gravitates toward assets that don't depend on another party's promise. Gold is the purest expression of that. It isn't someone else's liability. It doesn't need a central counterparty. It simply exists. So yes, part of Friday's move was classic risk-off behavior. Equities softened, volatility perked up, and precious metals caught a bid. But here's the twist almost nobody explains clearly. The same conflict that pushes safe haven demand can also push expectations for tighter monetary policy. And that creates a weird internal conflict inside the gold market that makes price action look choppy, confusing, and irrational to people who only understand the safe haven story. Think it through. Before the escalation got serious, a lot of the market was leaning toward rate cuts. You remember the narrative: inflation cooling, growth slowing, the Fed eventually easing, multiple cuts on the horizon, soft landing optimism. That was the emotional baseline. When a major geopolitical flashpoint hits, especially one that threatens energy supply and shipping routes, inflation expectations can rise. Energy volatility flows through everything: transport, manufacturing, food, packaging, services, everything. That pressure can force central banks to look less dovish, not more. So the same event becomes two forces at once: bullish for gold through fear and safe haven flows, bearish for gold through higher rate expectations and rising yields. And if you don't understand that tug of war, you'll look at the chart and think, why is gold not moving the way it should? It is moving exactly the way it should in a market that's being pulled by two opposing engines at the same time. That's why you get violent swings. That's why you get rallies that fade. That's why you get drops that reverse. The market is trying to decide which force dominates: fear-driven allocation into protection, or yield-driven allocation into income-producing instruments. Now let me ask you something quickly. Where are you watching from? Drop your city or country in the comments. And tell me how you hold your metals. Physical, ETFs, miners, options, some mix. It helps shape what kind of details are actually useful to you. Now let's go deeper into the yield story, because this is where most investors get trapped. Since tensions escalated, long-term Treasury yields have moved higher. Not by a tiny amount, enough that bond prices have taken real hits. People love to call Treasuries the risk-free asset, but if you've watched a 10-year note swing several percent in a short window, you know how misleading that phrase can be in practice. Here's why yields matter for gold in the short run. Gold doesn't pay interest. A Treasury does. So when yields rise, the opportunity cost of holding gold rises too. Some marginal buyers decide, why hold a metal at zero yield when I can get paid to hold a bond? That is a real headwind. It's happening. It's part of the reason gold can feel like it's fighting itself. But here's what the short-term thinkers miss completely. Why are yields rising? Yields aren't rising in a vacuum. They're rising because the market is demanding more compensation to absorb more and more government debt. At the same time, deficits remain enormous and refinancing needs are relentless. So yes, higher yields can pressure gold short-term. But the underlying reason yields are rising, fiscal stress, debt growth, heavy issuance, is ultimately bullish for gold over the medium to long term. Because the only sustainable solution governments reach when the math gets tight is some form of financial repression. Keep the system functioning by expanding liquidity, capping yields, or allowing the currency to lose purchasing power over time. People react to the surface signal and miss the deeper cause. They see yields up and assume gold down forever. But the deeper cause is the system is straining, and strain eventually brings policy responses that favor hard assets. This is one of the most common mistakes in markets, interpreting the immediate correlation and ignoring the structural driver. The people who sell their metal exposure because yields moved up are often the same people who come back later at much higher prices when the broader problem becomes obvious. Now let's talk about the biggest under-discussed reality in this market. Large institutional investors still are not meaningfully allocated to gold. This is astonishing when you step back. Gold has been one of the strongest performing major assets over a multi-year window, and yet the average institutional portfolio allocation is tiny, sometimes effectively zero. And it's not because institutions are all stupid. It's because institutions have incentives, habits, and internal politics that make them slow. There are two major reasons. First, expertise disappeared. A lot of big institutions reduced commodity and metals exposure after the last cycle cooled years ago. When they did that, they didn't just sell positions. They lost the analysts, the internal models, the institutional memory. The people who understood precious metals moved on. That knowledge wasn't rebuilt because equities were doing fine, and there was no career incentive to rebuild it. So today, many large asset managers literally don't have strong in-house capability to evaluate metals properly. And if you're a portfolio manager, proposing something you can't defend with internal consensus is a career risk. Second, inertia. If stocks are rising and your peers are all doing the same thing, it's safer, career-wise, to stay in the crowd. If you buy gold and it drops, you're the weird one who bought a rock. If you don't buy gold and it rips, you can say, nobody saw it. That's how institutional psychology works. But this creates a powerful implication. The big institutional wave of buying is still ahead. And when institutions finally move, it usually doesn't happen gently. It happens after some trigger forces attention. An equity drawdown, a credit event, persistent inflation, or simply peer pressure, when other major funds begin allocating and it becomes acceptable. Once it becomes acceptable, you don't get a trickle, you get a stampede. Because institutions don't move in ounces, they move in billions. And gold is not a large market relative to global pools of capital. If even a small percentage of institutional assets decide they need a gold allocation, the price doesn't drift higher, it can gap higher, because supply is not elastic in the short run. This is why I believe the move that makes the last few years look like a warm-up may still be ahead. Central banks began accumulating earlier. Some individuals came in more recently. But the big institutional reallocation event, the one that changes the conversation everywhere, has not fully arrived. Here's a story that illustrates this mindset perfectly. A large European family office, old money, multi-generational wealth, supposedly focused on preservation, was asked about their gold position. Their answer was essentially none. Zero meaningful allocation. But they had recently allocated hundreds of millions into Bitcoin. Now pause there. An institution designed to protect wealth over decades was comfortable deploying huge capital into an asset known for severe drawdowns, while dismissing the asset that has preserved purchasing power across centuries. Why? Not because of a detailed valuation model, not because of a careful risk framework, because leadership didn't like commodities, personal preference. That tells you where we are. Not at the end of the gold story, somewhere earlier, when the most obvious wealth protection tool is still treated as optional, unfashionable, or old world. Eventually, reality forces the reassessment. It always does. And when that happens, the people who ignored gold will discover they're late. And late in markets means expensive. Now let's shift to silver, because silver is not just cheap gold. Silver has its own personality, and you need to respect it. Silver is both a monetary metal and an industrial metal. A large portion of demand is industrial: electronics, solar, medical equipment, manufacturing inputs, things tied to real economic activity. That dual role matters right now. Geopolitical conflict doesn't just create fear, it can also slow growth. It disrupts supply chains, it delays corporate investment decisions, it tightens conditions. That can reduce near-term industrial demand for silver, even as safe haven interest rises. So silver often faces more cross-currents than gold. Gold is primarily monetary. Silver is monetary plus industrial. Here's what's interesting, though. Even with growth concerns, silver supply-demand has been tight for years, with deficits appearing repeatedly. That structural tightness can matter a lot when investment demand shows up, because silver is a smaller market and can move violently once it gets momentum. But in the short term, silver can lag gold if industrial concerns and rising yields outweigh the safe haven effect. This doesn't mean silver is bad. It means you need to know what you own. If you're holding silver as long-term monetary insurance, short-term industrial noise matters less. If you're trading silver, you need to understand it can underperform gold during certain phases and then suddenly outperform explosively once gold establishes a clearer uptrend. Historically, silver often follows gold's lead. Gold tends to move first. Silver tends to accelerate later. Now let's address the question that frustrates almost everyone. If metals are doing well, why are mining stocks not exploding? Because miners are not metals. Miners are businesses. They have costs. They have management risk. They have operational problems. They have political risk. They have labor issues. They have equipment failures. They have hedging decisions. They have jurisdiction exposure. They have dilution risk. And they trade inside the equity ecosystem. So when markets go risk off and investors sell equities, miners can get sold with the rest of the stock complex, even if gold is stable or rising. And there's another factor that matters, especially in a Middle East tension environment: energy costs. Mining is energy intensive. If oil rises, diesel rises, power costs rise, transport costs rise, margins can get squeezed. So sometimes gold can go up and miners can still struggle because costs rise too. This is why miners are not guaranteed leverage to the gold price in every environment. So what do? You decide what exposure you actually want. If you want clean exposure to gold's monetary role, own gold. If you want leveraged exposure and can tolerate operational complexity, miners can make sense. But you must accept that miner performance can diverge dramatically from the metal. The mistake is buying miners expecting them to behave like a gold bar with a turbo button. That's not how it works. Now we get to the real battlefield: psychology. Precious metals are emotionally brutal. The volatility is designed to make you doubt yourself. Narratives flip fast. You'll see gold drop on yield headlines, rip on geopolitical news, stall on hawkish commentary, then surge again when fear returns. It feels chaotic because it is chaotic. And the chaos serves a purpose. It transfers positions from impatient hands to patient hands. If you're feeling uncertain, if you're feeling tempted to sell and buy back when it calms down, understand that this feeling is part of the process. Markets often create maximum discomfort before the next leg up, because discomfort forces people to abandon positions. So your goal is not to find perfect certainty. Your goal is to have a process strong enough to survive uncertainty. Here's the framework that separates people who win in precious metals from people who get shaken out. You don't get paid for certainty. You get paid for discipline. Nobody knows whether gold will spike next week or pull back first. Nobody knows if silver will chop for months or snap upward suddenly. Anyone pretending they have exact timing is selling confidence, not analysis. But you can control process. Position sizing that lets you hold through volatility without panicking. Entries that don't chase emotional breakouts. A plan for what you do if it drops 10 to 15%. A plan for what you do if it rips higher quickly. Risk management that keeps you solvent and rational even when you're early. That's the edge. Not prediction. Process. So let me ask you directly, what's your plan? If gold drops hard tomorrow, do you already know what you'll do? Add, hold, reduce, do nothing? If gold breaks out and runs, do you know what you'll do? Take partial profits, hold core, rotate? If silver spikes fast, do you have rules, or are you going to react emotionally in the moment? You want those answers before the market forces the question, because when the move happens, you don't get hours to think, you get seconds. Write your plan in the comments. Seriously, put it into words. That alone makes it more real and less emotional. And tell me where you fall on the spectrum. If you've been in metals for 5 years or more, comment veteran and share the biggest lesson you learned. If you're new, comment newcomer and tell me what's been most confusing. That feedback shapes what's worth covering next. In the next video, I'm going to go deeper into the institutional allocation angle, because I believe that's the story that matters most for the big move. How much capital is actually underallocated? What happens if even a small slice of institutional portfolios decides they need gold exposure? What does that imply in a market with limited supply? We'll run the numbers and keep it grounded. And I'll leave you with one final thought that most people only understand after they've lived through a full cycle. Gold isn't necessarily getting expensive. The currency is getting weaker. Gold is a measuring stick. When it takes more dollars to buy the same ounce, that's not just gold changing, it's the dollar's purchasing power changing. Right now, the world is dealing with persistent deficits, difficult central bank trade-offs, and geopolitical tension that can accelerate inflationary pressure. The destination doesn't need to be guessed. The direction is visible. The only unknown is timing. So when you see volatility, zoom out. Remember what you own and why you own it. Remember that the people who dump positions during discomfort often become the buyers at higher prices later. In precious metals, the biggest gains tend to go to the people who can tolerate the most discomfort without losing their discipline. That's the price of admission. The question isn't whether the market will test you, it will. The question is whether your process can survive the test.